It's quite dire to note the growth rate in Angola is in 2011 it is expected to clock in at around 3.7% from the 18% that we saw in 2007 and 2008, and really having to do with the oil revenues that we've seen coming in. But Angola is still a very strong growth story on the African continent.
Absolutely. It's one of those economies that is endowed with significant natural resources, and that has been largely to explain or a contributing factor to its strong growth that we saw in the late 2000s when oil production started picking up quite significantly. And on the reverse side, we've seen oil production actually come off a little bit this year, with oil production actually disappointing to some extent, with only 1.5 million barrels per day being produced at a low this year, while expectations were that oil production would reach close to 2 million a day. So that's largely to explain, or it largely informs why growth has been a little bit more disappointing in the course of 2010 and 2011. On the other hand, we've also seen fiscal consolidation in 2008-2009 when oil prices reduced quite significantly. That exerted significant pressure on the fiscal expenses, and arrears in that time were accumulating quite rapidly to construction companies that were contracted by the government, and there was a need to at least reduce government expenditure in order to clear those arrears in the past 2 fiscal years. So on the one hand, the declining nominal amount of oil production as well as the consolidation of fiscal expenses has been the explanation of that decline in overall GDP growth. What's important to note there is that the non-oil GDP growth has, however, remained positive over the past 2 years, and it's actually led to a decline in the dependency in the nominal GDP figures on the oil sector, which is a positive phenomenon.
I'm glad you mentioned that, because I really wanted to get into the fact that is Angola a very good example on how African countries need to diversify away from their need to and their reliance on the resource space, and we've seen this coming through in Zambia. We're talking about that just a moment ago, but also the reliance of oil with the likes of Angola. You mentioned that we're starting to see non-oil revenue and non-oil performance with regards to GDP is starting to increase. Could you give us some more insights into the sectors that are actually starting to grow extensively?
Absolutely. So they are very reliant on oil. With regards to government revenues, over 90% of government revenues do derive from the oil sector. Equally so in terms of foreign exchange earnings, over 90% of their exports are comprised of oil. So therefore there is a very heavy dependence on oil for both the fiscal expenditure as well as the external sector. If we look at the compilation of GDP, we've seen that since 2002 there's been significant investment from both the private sector but predominantly the government sector into infrastructure, and therefore construction has been one of the fastest growing sectors in the economy. On the other hand, they've sought to improve the agricultural expenditure to, one, reduce the reliance on imported foodstuffs, but also to try and generate employment as well as reduce poverty in the rural areas of Angola. Obviously, before the civil war, Angola was actually one of the breadbaskets of the African continent, and this was unfortunately depleted when the civil war drove people off their land and created minefields where previously very successful commercial farms were operating. So in both those industries, we've seen an improvement which has allowed the dependence on oil in the GDP to decline, and that's likely to improve moving forward as, again, once we've seen the fiscal consolidation improve and the fiscal balances now allow for, again, increased public expenditure in infrastructure to further drive growth in these sectors moving forward.
Yvette, I mean, is this
private sector involvement in these sectors
is this all about, of course, policy with regard? I mean, you were going to talk about private sector involvement. Is it going to take policy to change these scenarios? Of course, you mentioned that Angola used to be a breadbasket within the region, and I think that actually we can talk about many African countries that have been breadbaskets before and subsequently have not been using arable land. So it is very specific to the African story. Is it about policy? Is it about more work with the IMF and the World Bank? What is it going to take to really see a significant turnaround and ensure that Angola is not relying on 90% revenues coming through from the oil market?
Well, for the private sector to be able to develop, you'll obviously need an improvement in the infrastructure for private sector outside of the immediate range of the cities to be able to develop. So one important drive over the recent past has been improving the rail and the road network across the country, and that is going to be the first bottleneck in order to alleviate some of the supply side constraints for economic growth, allowing roads to move products on as well as allow for improved basic necessities for the private sector to be able to operate in these economies is the first condition that what needs to be achieved. In terms of the bureaucratic requirements and, for example, the difficulty in getting licensed to operate in Angola, that will be a second area that will need increased focus to enable to improve the business operating environment in Angola.
Yvette,
so reducing the number of licenses that are required. And
yeah, I just want to touch on the inflation rate as well, because they've got a target of 10.5%. It's sitting at 11.9% year on year in the month of October. It's down from 15%. Obviously, Forex is very important when it comes to inflation, but more so you're talking about the importation of goods. Give us your sense with regards to the actual monetary policy environment very quickly, please.
Well, the main transmission mechanism for inflation, it remains through the import channel, and therefore the exchange rate is the most important factor when it comes to determining inflation moving forward. We've seen a devaluation of the currency in the recent past due to the decline in oil prices. Since then, the currency's remained relatively stable, although it's depreciated somewhat over the past 2 months at about 2%. But that more stable nature of the exchange rate has been pivotal in at least stabilizing the cost of imported goods, and moving forward that will remain the most important transmission mechanism for the price of goods to the local market. They have introduced a new monetary policy framework whereby the Monetary Policy Commission will henceforth be setting the reference rate. It's currently at 10.5%. However, the transmission mechanism of that to the local liquidity as well as the cost of goods which predominantly come from abroad is limited.